So you're a millennial. If you fit that label, that means you're kind of in your late 20s, early to mid 40s, and you're a part of a generation that has been studied, talked about in every area of life, like the workplace, your relationships, your fitness, your values, all that stuff, but also in the way that you plan your money and invest your money. And that's the focus for our conversation today. Our guest is Mark McGrath. He is a financial planner and associate portfolio manager at PWL Capital. He is also the co-author of a book called Wealthier, the investing field guide for Canadian millennials. He joins us today from Victoria, BC. Hello there, Mark.
Hey Bruce, how are you?
You are a millennial. You fit this demographic definition. In what ways is your generation different when it comes to investing?
Yeah, great question. I think there's a few things. One, just purely the access to information that we have these days. It's so wide and so deep, and just the amount of people out there that are trying to kind of navigate all of the noise of not only the markets, but of personal finance in general. They just have so many options on where to kind of learn from, both good and bad. So there's the sort of information overload that I think the kind of my parents' generation didn't really have to contend with the same way that millennials do today. And then just in terms of how they interact with money and the sort of the economy at large and what's going on in terms of the cost of land. I'm in Victoria right now. I live in Squamish. As we know, British Columbia is a pretty expensive place. So just even, personally, the cost of living and just how difficult it is to kind of get ahead. I think that's a lot different than the older generations as well.
You argue right off the top that investing is simple and easy. Why do you say that? Why do you say that with such conviction?
Yeah, investing itself has largely been solved, in my opinion, and my friend and colleague Ben Felix says this all the time, like investing has been solved. And what he means by that and what we mean by that is that if you can cut through the noise, it's actually very, very simple. There are tons of incredible options these days for investors to buy one or two, single products or ETFs, exchange traded funds, and have themselves access to a globally diversified portfolio of all the companies in the world that you'd want to own, and set it and forget it. And you can do that for incredibly cheap. So this sort of, financial innovation, I think, in how simple it is to access these types of portfolios, that part of it is very simple and easy. So if you can do that, and if you can behave well, then I think investing has largely been solved.
And there are some pitfalls. You have a section called bad investing. What are some examples of the ways to do it wrong?
Yeah. And unfortunately, it's very common. And as I said, there's so much noise out there and so many, gurus that people like to follow. And a lot of those gurus are not necessarily, educated or well trained in personal finance, but they built up a following. And so I think there's probably a few ways that are okay in terms of how to manage a portfolio, but there's a lot of mistakes. And I think probably one of the bigger ones is just trading too much and over trading and always seeking like the hottest trends. Think about it. We're just inundated with information daily from our phones, from TV, from our computers, and there's always something kind of flashing in our face about some company, whether it's Nvidia or Apple or something like that. And it's very easy to think that that information is useful to us in terms of investing, right? And it's largely not. But people tend to kind of chase these headlines and chase returns by just acting on information and not being able to kind of take some information and just set it aside and ignore it. And it causes over trading, which tends to lead to worse performance over time and higher fees. So I think that's the big one. And I think another one is just seeking kind of some secret sauce. Like, as I mentioned off the top, investing is largely solved by these simple, really boring, cheap portfolios. And for a lot of people, it's too easy, right? Like they are maybe skeptical that's actually the case. And so they're always looking for some kind of alternative to kind of juice up their portfolio. And I think that's mostly an exercise in luck and not a great way to manage things over a long period of time.
I agree. I agree with you that the investing side is solved. What is not solved is the advice challenge. And in your book, you argue that millennials need advice. And it's really hard to find advisors, and it's a tough expense for a lot of people to pay for, provided you want to get outside of the traditional mutual fund sales world. So what advice do you have on finding advice?
Yeah, great question. And the major benefit that millennials have these days is that access to advice and choices in how to pay for that advice have come a long way. Right? You mentioned the traditional kind of mutual fund sales. our industry was largely built, I say our industry, I mean the financial advice industry was largely built on commission product sales. And it's very difficult, I think, to argue that being compensated by selling a product is going to necessarily lead to the best outcome for, say our clients. But these days, there's still commission sales, but there's also things like what we call advice only planning, where it's like, hey, I'm going to manage the portfolio myself, but I want to pay somebody to just give me a plan, right? So first things first is you've got a lot of choice. It doesn't have to be what we call AUM or assets under management, where you're paying a percentage of your portfolio every year. That's how our firm operates, but that's not for everybody. So the first thing is just realize that there's lots of choices out there. And I say in terms of finding a good advisor, it's difficult again because there's so much noise, but the easy place to look is just for credentials, right? Like there's the CFP, the Certified Financial Planner designation, which I would argue is sort of the gold standard for a financial planner. So look for that. Look for referrals from friends. Look for thought leadership. Go online, Google these people, and say, look, are they creating content around personal finance? Are they writing in the Globe and Mail? Are they on, Bruce Sellery show, for example? So you can filter out, I think, a lot of people just by doing some kind of basic online research and then maybe looking for referrals from friends.
You include a whole section on socially responsible investing. And I'm interested, I'm not surprised because that's a real value for lots of millennials out there. And I think it could be a pitfall for people who think about impact investing in much the way they think about crypto or alternative investments. How do you reconcile those two notions? The one of like simplicity, diversify, buy cheap, and the other, which is at least slightly more active.
Yeah. And huge shout out to Tim Nash. He essentially wrote that section, and he is very deeply ingrained in kind of impact investing and sustainable investing. So he's an expert in that. I think as investors we have preferences, and we have values, and we have to kind of tailor our investing experience to those values to the degree that we can. But there's always going to be some kind of trade-off, right? I mean, if we start with that simple, the investing is solved largely. Okay, that's a great baseline. But from there, if we have some preferences or some places that we want to, eliminate from our portfolio, certain sectors or certain types of companies or something like that, then we're going to have to get a little bit active. And investing is always active in some way. There's always some active decision to be made around investing. So I think that kind of active investing, if it fits your values, you just kind of want to take things away one at a time until you're arriving at the sort of passive index style portfolio that best fits your values, your philosophy.
You use the phrase a stoic investor mindset. No one has ever described me as being stoic in my life, not one single time ever. What do you mean about a stoic investor mindset?
Yeah, and this is largely just about managing your own behavior, right? And as I mentioned earlier, there's so many easy ways to kind of trip yourself up just by information overload. And really the best way to manage your investment experience is largely to set it up well in the first place and then try to ignore it. And that's really difficult. And that takes kind of active practice. Like myself, I don't check my portfolio at all. I'd say maybe once a year, and not because I'm actually curious about the value of it, but only because I have to log in to get some other piece of information and I see the value of it, right? I don't care about what the market's doing. I don't care about the news of one particular stock or the tariffs that we're talking about right now. That doesn't affect me over the very long run. Markets are noisy. Markets are volatile. We have to accept that. That's kind of the price we pay for strong long-term returns. And so the idea of being stoic is once you kind of set that foundation in place, it's an active practice of making sure that you're not tinkering too much and that you're thinking about things with the long-term mindset.
Even though you earn your paycheck providing traditional financial advice, you still see an opportunity for DIY investing. What did you want people to take away from the book on that particular approach, the DIY approach? How to do it, when to do it, why to do it?
Yeah. Yeah, and I think, there's a lot of advisors that would maybe disagree with me that think everybody needs an advisor at all times throughout their life. And I just don't think that's the case. And I mean, look, I spend a lot of time on social media and on Twitter and talking to people, and it's become very, very, very clear to me over time that there's a lot of people that are absolutely capable of handling their own finances. And maybe they need, a check-in with an expert once every 5 years or something like that. But the goal with this book, and I think Dan's vision of the book originally, was to kind of empower people to say like, hey, you are capable of doing this yourself. It's a lot more complicated than just picking a portfolio, though, because personal finance and financial planning goes far beyond that into estate planning and risk management and insurance and retirement planning and tax. There's a lot of areas here that you might not be considering, but a lot of this you might be able to manage yourself at least for a period of time. And there may come a time in the future where, due to the complexity of your situation or a lack of interest, you might decide to hire advice of some kind. So the idea was, let's empower millennials to take control of their wealth, to build their wealth, and then give them the tools and options for how they manage that down the road too.
For anybody, but for millennials in particular, they are in what may be their peak earning years, or at least coming into their peak earning years, but still some real runway before they're going to retire. A question that you address in the book that I think is on the minds of so many people is, what's my number? How much
Yeah.
do I actually need? What's the true north that I am pointing myself to such that I've got financial freedom? What's your
Yeah.
top advice on helping people think that through?
Yeah. It's a difficult way to think about that question because, to your point, everyone has a number, and we as humans like to anchor to round numbers as well, right? So I always, growing up, a million sounded like an unlimited amount of money. And the older I get, the less that is worth, just because of inflation. But obviously, the more that number becomes kind of meaningless, because if you're just looking at the value of a portfolio as an example and saying that's my number, well, you need to consider a lot of other things. You need to consider the tax makeup of that number. Is it all RSPs, which are pre-tax dollars, or is it all in a tax-free savings account, which is post-tax? You have to consider things like the Canadian pension plan, old age security. Maybe you have other pension income. Maybe you're taking care of aging parents and you've got 5 kids of your own with your family. Maybe you live in a high cost of living area. So there's just so many factors that go into financial independence that I think picking an individual number is helpful as a rule of thumb and is helpful as a kind of a true north, like a guiding target. But I would encourage people to keep in mind that that number by itself tells you very, very little about whether or not it's reasonable and sustainable over long periods of time.
Really interesting stuff, Mark. Congratulations on the book, and thank you for joining us today to talk about it.
It's my pleasure. Thanks for having me.
Mark McGrath is a financial planner and associate portfolio manager at PWL Capital. He is co-author of the book Wealthier, the investing field guide for Canadian millennials.